All right, let's get straight to it. Today, we're tackling a concept that's absolutely fundamental to, well, everything. Finance, business, your own personal wealth, it all comes down to assets. So we're going to build a really powerful, strategic framework to help you understand exactly what they are and, maybe more importantly, how to think about them.
So here's our game plan for this briefing. First, we'll get right to the core answer. What is an asset? Then, we'll build out a framework for understanding them. From there, we'll do a deep dive into the two major types, tangible and intangible assets. After that, we'll look at the other side of the coin, liabilities. And finally, we'll talk about how you can put all of this to work for yourself. Sound good? Let's go.
You know, in any really effective analysis, you start with the answer first. So before we get into the frameworks and all the details, let's just cut right to the chase. What exactly is an asset?
Okay, here's the textbook definition, but let's make it real. An asset is an economic resource that you own or control. It has monetary value and, this is the important part, it's expected to provide a future benefit. Let's pull that apart. Owned or controlled just means it's yours. You have a legal right to it. Monetary value is simple. You can put a price tag on it. But that last piece, future benefit, that's the real magic. It means this thing is going to help you down the road, maybe by making you money, going up in value, or just helping a business run better. And this definition, it works for everyone, from you and me to the biggest companies in the world.
So what are the telltale signs of an asset? Think of it like a little checklist. First, it has to have some value right now, and you should be able to turn it into cash, at least in theory. But the real power, the real reason we care, is its potential. It might kick off income, like rent from a property. Or it could grow in value over time, like a stock or maybe a classic car. For business, it's even more straightforward. An asset has one of three jobs: generate cash flow, cut down expenses, or boost sales.
All right, if we really want to get a handle on this, we can't just have a loose collection of ideas. We need a solid framework. So we're going to borrow a classic tool from the world of strategy consulting. It's called a Mies framework. Now that sounds fancy, but all it means is mutually exclusive, collectively exhaustive. Basically, we're going to slice the world of assets into clean, distinct buckets that don't overlap, but when you put them all together, they cover everything. It's a super powerful way to think.
Okay, so the very first split in our framework, the highest level, comes down to one super simple question. Can you physically touch it? Seriously, that's it. This one distinction, whether it has a physical form or not, creates our two main categories of assets.
And those two categories are tangible and intangible. Pretty straightforward, right? Tangible assets are the stuff you can literally put your hands on. Think buildings, cash, machinery. You can see them, you can touch them. Intangible assets, on the other hand, they lack that physical substance, but wow, they can be unbelievably valuable. We're talking about things that represent a legal claim or a powerful idea, like a patent on a new drug or the reputation of a brand like Apple or Coca-Cola. So let's double-click on each of these and see what's inside.
Okay, let's dive into the tangible world first, the physical stuff. Now, inside this category, we can make another clean cut, another Miesy split. This time, we're going to sort things based on their time horizon, or to put it another way, how quickly you can turn them into cold, hard cash.
And that split gives us two new buckets, current assets and fixed assets. The magic number here is 1 year. Think of current assets as short-term resources. They're things a company expects to either use up or convert into cash within a year. They're super liquid. Fixed assets? Well, those are the long-term workhorses. These are the big-ticket items a business plans to use for more than a year, and they're not something you can just sell off tomorrow.
Let's make this super concrete with some examples. In the current assets bucket, you've got the obvious one, cash. But you also have things like accounts receivable, that's just a fancy term for the money your customers still owe you, and of course, any physical inventory you have on the shelves. Now, over in the fixed assets bucket, that's where you find the heavy hitters. Buildings and land, machinery, company trucks, all that stuff. And trust me, understanding this difference is absolutely critical if you want to figure out if a company is financially healthy or not.
Now, since these fixed assets stick around for a while, they wear out, right? We have to account for that. And that's where a concept called depreciation comes in. Now listen closely because this is a really important point. Depreciation is not about what the asset is actually worth on the open market. It's an accounting trick. It's a way to take the original cost of that asset and spread it out over its useful life. It's all about matching the cost of the thing to the money it helps you make over several years.
The most common way to do this is called the straight line method, and it's exactly as simple as it sounds. First, you figure out what the asset cost. Then, you estimate how long it's going to be useful. For example, the The IRS has tables for this, and they'll say a truck has a useful life of 5 years. So you just take the cost and divide it by the number of years. A $50,000 truck, you divide by 5, and your annual depreciation expense is $10,000 a year for 5 years. See? Simple, logical, and it's a must-do for the accountants.
All right, we've covered the stuff you can kick. Now, let's pivot to the other side of our framework, the non-physical world of intangible assets. And please, don't let the fact that you can't touch them fool you. In today's economy, these are often the most valuable things a company owns, period.
So what are we talking about here? Well, there are a few key types. You've got patents, which give you the exclusive right to an invention. You've got trademarks, think the Nike swoosh or the Golden Arches, that protect a brand's identity. Copyrights protect things like books, music, and software. And then you have these two big ones. Goodwill, which is basically the premium you pay for a company's reputation when you buy it, and brand equity, which is the sheer commercial value that comes from how people feel about your brand. Make no mistake, these things are what create massive, long-lasting competitive advantages.
Okay, so we've spent all this time talking about one half of the story. But you can't truly understand assets until you understand what they're balanced against. We need to talk about their counterpart, liabilities. These two things are the yin and yang of the entire financial world.
Honestly, it boils down to something this simple. Assets are what you own, liabilities are what you owe. That's the fundamental balance. For you personally, the money in your savings account, that's an asset. The student loan you're paying off, that's a liability. Your house is an asset, but the mortgage you used to buy it is a liability. And it's exactly the same for a company. The cash on hand is an asset, the bank loan they took out is a liability. It's a perfect mirror image.
This right here, this perfectly explains the beautiful symmetry of the whole thing. Think about it. If you lend money to someone, that loan is your asset. Why? Because it represents a future payment coming to you. But for the person who owes you that money, that very same loan is their liability. It's their obligation to pay you back. Every single financial transaction creates this two-sided entry in the universe's ledger. One person's asset is always another person's liability.
Okay, we've laid out the framework. We've defined all the key terms. Now it's time to make this real. Let's pivot from the theory to a much more interesting question. How can you use this strategic view to build your own asset base? Because really, this is where the rubber meets the road. This is where this knowledge becomes actual power.
So let's talk strategy. When you pay down high-interest debt, what are you really doing? You're attacking your liabilities, which is a guaranteed financial win. When you contribute to your 401k or an IRA, you're systematically building your stack of long-term tangible assets. That emergency fund everyone talks about, that's a crucial current asset. It gives you liquidity and peace of mind. And of course, when you invest in stocks, bonds, or ETFs, you're using your cash to acquire financial assets that can grow and generate more wealth. It's all about strategically building up that asset column while managing the liability side.
So there you have it. We've taken this big concept of assets and broken it down using a clear, logical framework. You now have the tools to categorize them, understand them, and see how they fit into the grand scheme of things. So the real question isn't just which assets will you build next. It's, now that you have the framework, how are you going to think differently about every single financial decision you make from here on out? Something to think about. Thanks for watching.